Did you know that the S&P 500 on average has returned about 10.5% annually over the last 6 decades? Imagine steadily growing your wealth over time with minimal effort and doing it in a way that reduces risk while maximizing potential profits. That's exactly what dollar cost averaging can help you achieve. Dollar cost averaging is one of the simplest and most effective methods of investing. It's how many everyday people, without needing to know much about the stock market, are able to build significant wealth. This strategy requires very little knowledge, no guesswork, and eliminates the stress of trying to time the market, yet offers unlimited potential for long-term profits by consistently investing the same amount of money at regular intervals. Regardless of how the market is performing, you spread your risk and smooth out the price of your investments over time. In fact, studies show that regular investors who dollar cost average are less likely to make emotionally driven investment decisions, increasing their chances of long-term success. Let's break down exactly what dollar cost averaging is, how you can use it, and why it's such a powerful tool for achieving financial freedom. Plus, I'll share where you can invest your money to earn great returns, sometimes up to 10% or more annually, with little to no active management. Welcome to Whiteboard Finance, where we teach you how to invest and manage your money. If you're interested in improving your financial future, make sure to subscribe and hit the like button if this video helps you. So what exactly is dollar cost averaging? It's the strategy of investing a fixed amount of money on a regular basis, whether weekly, monthly, or even daily, regardless of price fluctuations. For instance, let's say you decide to invest $500 every month into an ETF. When the share price is $100, you'll buy 5 shares. If the market drops and the ETF falls to $80 per share, your $500 now buys 6.25 shares. And if the price rises to $120 per share, you'll only buy 4.16 shares. Over time, this strategy lowers your average cost per share compared to lump sum investing, especially if you stick with it during market downturns. A Vanguard study found that dollar cost averaging reduces the risk of investing during volatile periods by 37%. One of the biggest benefits of dollar cost averaging is that it can be done automatically. You can set up automatic contributions from your paycheck into a 401k or from your bank account into an IRA or brokerage account. This takes the guesswork out of investing, ensuring you stay consistent and avoid the temptation to time the market. Why does this matter? Because historically, investors who stay in the market for the long haul tend to outperform those who jump in and out. If you had invested a lump sum right before the 2008 financial crisis, you'd have suffered big losses. But if you dollar cost averaged throughout that period, you would have continued to invest during the downturn and picked up shares at bargain prices, setting yourself up for bigger gains when the market recovered. There's a lot of research backing this up. A Fidelity study found that people who automate their investments and stick with a consistent plan are 25% more likely to stay invested during market downturns, leading to better long-term performance. Now, where should you be investing this money? One of the best places for long-term consistent growth is the S&P 500. This index represents the 500 largest profitable companies in the U.S., spanning all market sectors. Over the long run, it's been a proven performer, returning an average of 10.5% per year from 1957 to 2021. The beauty of investing in the S&P 500 through low-cost funds like those offered by Vanguard or Fidelity is that you get broad diversification across industries and companies with extremely low fees. Warren Buffett himself recommends the S&P 500 for most investors because it's a simple way to gain exposure to the U.S. economy's most successful businesses. To sum up, dollar cost averaging offers many advantages. It reduces the risk of poor market timing, especially during volatile periods. It helps you build wealth consistently over time without emotional decision-making. Automating your investments makes it easier to stick with your plan and avoid disruptions. The S&P 500 offers a historical average of 10.5% returns, giving you excellent long-term growth potential. So, while dollar cost averaging might not always provide the highest possible returns compared to lump sum investing, for the average investor, it's one of the best ways to build wealth steadily, avoid emotional decisions, and enjoy the peace of mind that comes with a set it and forget it strategy.